What if you could control $100,000 worth of Tesla stock tomorrow with only $465 in your account and turn it into $4,500 or more in a few weeks without ever buying the stock? Sounds like a scam, right? It's not. It's called options trading, and by the end of this video, you'll understand exactly how it works. Most people think options are complicated, confusing, or only for Wall Street pros with math degrees. And honestly, I get it. Every tutorial out there throws Greeks, IV percentiles, delta gamma hedging, and complex spreads at you before explaining what you're actually buying. Most tutorials start with the advanced stuff, the complicated terminology, the charts, the formulas. Today, we do the opposite. We keep it simple. We focus on two building blocks of every option trade on the planet: calls and puts. Let's get rid of the confusion once and for all. I'm going to break down options so clearly that you'll understand exactly what you're buying, how to make money, and how to avoid the three mistakes that kill 90% of beginners. No math degree required. An option is a contract. Nothing more, nothing less. A contract you can buy and a contract you can sell. But what does that contract do? The contract gives you a choice. Not an obligation, a choice. Think of it as a legal agreement that gives you rights, not responsibilities. A call gives you the right to buy something at a set price. A put gives you the right to sell something at a set price. That's the entire foundation. Two tools, two choices, and from those two, every other strategy in the world is built. At its core, an option is a contract that lets you control a stock without owning it. Strip away all the noise and all the complexity. Options are literally just two things. A call option equals you want the stock to go up. A put option equals you want the stock to go down. That's it. Direction. Up or down. Nothing else about options makes sense until this part clicks. So before we go any further, comment right now call if you think you understand calls, or put if puts make more sense so far. Let's see which side wins. Actually, before we continue, let me kill three lies you've probably heard. Lie number one, options are just gambling. False. Gambling has no skill ceiling. You can't get better at roulette. But options reward research, timing, and understanding market behavior. Lie number two, you need 25 grand to trade options. Wrong. You can start with as little as $100. Seriously. Lie number three, most option traders lose money. True, but most beginners lose money because they skip videos like this one. They chase cheap lottery tickets instead of understanding what they're buying. You're already ahead just by being here. To make this crystal clear, forget the stock market for a moment. Think about real estate. You find a house worth $300,000. You're not ready to buy it, but you want the right to buy it at the $300,000 price for the next 90 days. Maybe you're waiting on the loan approval. Maybe you're doing more research. Maybe you just want to lock in that price before it goes up. So you pay the owner a small, non-refundable fee, let's say $5,000. Now, that $5,000 fee is called the premium. The $300,000 locked-in price is the strike price. The 90-day window is the expiration date. Within those 90 days, if the house value jumps to $400,000, you win big. You locked in the $300,000, but the house is now worth $400,000. You can either buy it at your locked-in price and flip it for a profit, or you can sell your contract to someone else who wants that deal. But if the 90-day window passes and the house drops in value or stays flat, you only lose that $5,000 fee. Not $300,000, just a fee. That is literally a call option. Now, flip the logic. Let's say you own a classic car worth $100,000 and you're terrified the market's about to crash. You can't sell it right now. Maybe you're waiting for a buyer. Maybe you love the car and you don't want to let it go yet. But you want protection. So you pay someone $2,000 for the right to sell your car for $100,000 anytime in the next 60 days. Even if the market crashes and your car is only worth $60,000. That's insurance. That's peace of mind. That's a put option. Two simple tools, two simple directions. Remember that house example, that car example? Every option trade you'll ever make follows that exact same logic. Premium equals your deposit, your fee, your cost. Strike price equals your locked in price. Expiration equals your deadline. That's your mental model. Now, let's get back to the stock market. The options market exists because people want flexibility. They want control without full commitment. You can think of an option like a cheap reservation on a stock. A call is a reservation to buy the stock later at a set price. A put is a reservation to sell the stock later at a set price. You pay a premium for that reservation. That premium is your risk. It's the maximum you can lose when buying options. Not up to, not potentially, that's it. If you pay $200 for an option, $200 is the absolute worst case scenario. You can't lose more. Ever. That's why buying options is actually less risky than buying stocks for beginners. Your loss is capped from day one. Buying an option is never unlimited risk. It's limited to the premium. A call is simply this. You think the stock will go up, so if you buy a call, you're betting that the stock will rise above the strike price before the expiration date. But here's what nobody tells beginners. You don't need the stock to actually hit your strike price to make money. Let me say that again. You don't need the stock to actually hit your strike price to make money. If Apple is at $200 and you buy a 210 call, you don't need Apple to reach $210. If Apple jumps to $205 and there's momentum, buying pressure, hype, earnings coming up, your options value could double or triple just from the movement. Options gain value from movement, momentum, demand, and time left. That's the magic of leverage. So let's break down what you're really buying. You're buying potential. You're buying the right to benefit from a move upward without needing to buy the stock itself. That's why people use calls. Small cost, large potential upside, defined limited risk. Your worst case scenario with a call option, you lose what you paid for the contract, the premium. That's it. Your best case, the stock shoots up and your call multiples in value. A put is the opposite idea. I think the stock will go down. Buying a put gives you the right to sell at a certain price before the contract expires. Here's the mindset shift. A put doesn't mean you're negative, bearish, or doomsday thinking. It simply means you expect the price of a stock to fall. And if you want to profit from that fall, that's why people buy puts. Because markets fall faster than they rise. It's just physics. Fear spreads faster than greed. And stock can take 3 months to climb 20% and drop 20% in 3 days. Puts let you profit from that panic, and they're often cheaper because most people are naturally optimistic. For example, if a stock is at $100 and you buy a put with a strike of $95, you're positioning for a drop. If the stock falls to 90, your put becomes more valuable because you locked in a higher sell price than where the market actually went. Just like calls, your worst case, you lose the premium you paid. Your best case, the stock drops fast and your put gains value immediately. Puts also act like insurance, protection against market crashes or portfolio losses. But they're also opportunities. For traders who understand the downward momentum, they can be very powerful. Every option, every single one, has only 3 numbers that truly matter for beginners. I call them S.E.P. Strike, Expiration, Premium. Master these 3 and you can trade any option on any stock on any platform. Let me break down each one. Number 1, the strike price. This is the price level you're choosing. For a call, you want the stock price to move above the strike price. For a put, you want the stock price to move below the strike price. Think of it as your target. Number 2, the expiration date. That is the deadline. The contract lives until this date. Then it dies. The more time left, the more flexibility you have, but the more expensive the contract. The less time left, the cheaper the premium, but the riskier the trade. It's a trade-off. Number 3, the premium. This is the cost of the option. It's the most you can lose. You're not risking your entire account, only this amount. Call premium rise when the stock goes up, put premiums rise when the stock goes down. That's the whole game. Why do people buy calls? Because buying shares can be expensive. For example, if Apple is $200 per share, owning 100 shares costs $20,000, but a call option might cost $250. Instead of risking $20,000, you put $250 on the table to control the same 100 share movement. If Apple jumps to 210, you benefit from that move through the contract. Here's where it gets crazy. If Apple jumps from $200 to $210, your shares make you $1,000 in profit. But the same $10 move could turn your $250 option into $1,200 or more. You risk 98% less money for potentially more profit. That's why people call options leveraged plays. Screenshot this part. Seriously, this is the framework I wish I had when I started. Now this trips up everyone at first. One option contract controls exactly 100 shares. Always. So when you see $2.50 on an option chain, that's not the total cost. You have to multiply it by 100. This is the part nobody teaches you. Here's the mindset shift that changed everything for me. Options aren't gambling, they're not about guessing, they are about scenarios. Before every trade, ask yourself 2 simple questions. Question number 1, do I expect the price to move up or down within a certain time? That tells you whether to choose a call or a put. Question number 2, how fast do I think the move will happen? That tells you how much time you need, which expiration to pick. If you expect a slow move, choose more time. If you expect a fast move, shorter expiration is okay, but it's riskier. Options become simple when you stop thinking about the option itself and start thinking about the story of the stock. What's happening with the company? What's the market doing? What's the sentiment? Is there news coming? Beginners don't lose because options are complicated. They lose because they make 3 simple mistakes. Mistake number 1, choosing expirations that are too short. They buy a 1-day option and hope for a miracle. They treat it like a lottery ticket. The fix, give yourself time. At minimum, 2 to 3 weeks for beginners. Ideally, 30 to 45 days. Time is your friend. Do not rush. Mistake number 2, buying strikes that are too far away. They choose the cheapest contract because it looks exciting, but it rarely hits. That 50-cent option is cheap because it has a 5% chance of working. You're setting money on fire. The fix, choose strike close to the current price, within 5 to 10% of where the stock is trading now. Mistake number 3, trading without a direction. They buy a call or a put without a reason for the move. No thesis, no research, just hope. The fix, have conviction. Don't buy a call just because someone on Twitter said to. Have a reason, a story, a direction based on research, news, or technical analysis. If you can't explain why you think the stock will move, do not trade. As a beginner, you only need two simple plays. A call when you expect the stock to go up, a put when you expect the stock to go down. You're learning the core building blocks. Everything else comes later, if you even need it. People become profitable not by knowing everything, but by mastering the basics deeply. Options give you leverage. Options give you flexibility. Options give you opportunity. But they also require patience, discipline, and direction. If you understand calls, if you understand puts, if you understand strikes, expiration, and premium, then you're already ahead of 90% of new traders. This is the foundation, this is the core. And once you master these two tools, the entire option market opens up to you. So, here's your homework before episode 2. Pick one stock, just one, watch it for the next week, ask yourself, do I think the stock is going up or down? That's it. Don't trade it yet, just watch. Get comfortable having an opinion. Get comfortable observing price action. That's where every option trader starts. Drop the stock you're watching in the comments. I want to know what's on your radar. If this finally made options click for you, hit that like button. It tells YouTube to show this to more people who need it. Subscribe because episode 2 drops next week and we're covering the math that actually matters. Break evens, intrinsic versus extrinsic value, time decay, the silent killer of most options trader, and how the pros flip the script and use time decay to collect premiums instead of losing to it. Comment below what stock are you watching right now. Let's discuss. I'll see you in episode 2.